Welcome to the last Friday takeaway of 2017. Phew! In a Christmas shortened week, the big news wasn't great. Reports said Apple has slashed Q1 sales forecast for its iPhone X by a massive 40% to just 30 million units, simply because it's just too expensive and packs too few innovations. Bitcoin, meanwhile, had a volatile Christmas. They've had a massive 100% price swing in December alone, as high as $19,500 on the 16th, as low as $11,000 on the 1st, and Morgan Stanley waded in saying that if nobody accepts Bitcoins for e-commerce payments, the value could be zero. Back home at the ranch, the government has said that electricity prices on the peninsula would stay the same from now until the end of 2020, and that's thanks to nearly R1 billion in subsidies and rebates between now and mid-2018. The KLCR was up 1.2% at 10 a.m. to 1,780 points, just 1% higher from last Friday's closing, possibly due to some window dressing by fund managers. Year-to-date, the index is a tad up over 8%, and CIMB have kept their end 2018 KLCR target at 1,790 points, saying that its top 5 themes for the next 2 years are 1. Beneficiaries of the strong ringgit, 2. GE14, 3. China's Belt Road Initiative, 4. PNB's transformation, and 5. The small mid-cap sectors. Moving on to some big weekly movers. Sime Darby Property got a huge CIMB thumbs up. They were until this year part of the former Sime Darby conglomerate, but are now a standalone developer with a massive 21,000 acres and land bank, valued at nearly 19 billion ringgit. CIMB says the massive land bank gives it the best of both worlds, i.e. being both a developer and asset owner at the same time. Plus, it's also got nearly $250 million in assets waiting to be sold, including some investment and hospital properties. Today, they're up 0.7% to 146 and higher by around a fifth in the past month alone. Its strength is also its weakness, with around 58% of its land bank in the overheated Klang Valley, where the short-termers are concerned since this is where any price correction would be most pronounced. And its size also makes it susceptible to ever-increasing marketing and raw material costs, not to mention the cost of maintaining all their people and machinery in a still weak property down cycle. CIMB just began covering the stock with an RNAV-based target price of 158, based on a price RNAV target ratio of 0.55 times. Now, Hibiscus are an upstream oil and gas company also famous for being Malaysia's first ever special purpose acquisition vehicle, aka SPAC, i.e. a shell company with a team of experts in a particular field, in this case oil and gas. Now, Hibiscus was heavily traded this week, not only because they're adding to the portfolio of assets by buying 50% at a North Sabah oil field from Shell, but also because prices of benchmark Brent crude oil have risen to over $65 a barrel. Today, Hibiscus are up by 1.2% to 88 cents and doubling in value since September. At current levels of around 34 times earnings, Hibiscus is not cheap, nor is the current price recovery assured by any means, because they're coming as they are from OPEC production cuts rather than a demand bounce. Public Bank has a target price of 1 ringgit and 6 cents on Hibiscus, while BIMB forecasts 85 cents.